Is the stock market preparing for another correction? That's a question that many people at or near retirement might be asking themselves. Here to discuss some alternatives is David Templeton with Adage Financial Consultants in Little Rock, Arkansas. David, it's a pleasure. Welcome back.
Thanks, Scott. Glad to be here.
So the markets have rebounded from that drop in 2008. Has that made people more bullish, do you think, on the market right now?
Well, I'm not too sure if bullish is the word. In fact, today it's coincidental. We are being interviewed on the day we just, July 11th, 2013, we just set another record high on the market today. But I think it's just because people are still, trying to recover some of their money they lost back in the last Great Recession back in 08 and 09 and get back in when it's really kind of too late to get back in right now in some people's minds.
And so is this a run in the market that you think can be sustained for some time?
There's a lot of different opinions on that by some of the leading economists around the country. Some say the markets are fine because, recent growth in the economy has been sustained, and while others think collapse is imminent. But the truth of the matter, what I personally feel is once it's pretty easy to figure out, once the Fed stops pumping money into the economy with its quantitative easing policy, I think everybody pretty much agrees that might be the bottom of it. And all it takes these days is for the Fed to come on and mention anything, a one-line sentence, and the market reacts in wild swings up or down. We've seen an 8 or 9% swing just in the last month, and today we're back up to the top, so everybody seems happy again.
And when we're talking about retirement planning, the topic of interest rates always comes up. And in one sense, for the economy with money cheap, that's kind of a good thing. But when someone is planning for their retirement, low interest rates really don't help. Can you talk about that?
Well, we've been in a low interest rate environment, in fact, a historical low interest rate environment now for a little bit over 3 years. And we're not seeing interest rates really rise on fixed investments like CDs or money market accounts, but the main driver of that is our 10-year Treasury notes, and they're actually increased substantially just in the last 2 or 3 weeks, and I think we'll see some small rises in other guaranteed CDs or money market accounts, but still they're at levels well below the 1% range. And so as we try to advise most of our clients, we have to take some sort of position to where we're tying some of our money to the stock market without risking any of our principal, so we can participate in some of the gains of the market. But at the same time, we have to get them to diversify their assets in a way to where we're not just sitting back on safe money and not making any interest and letting inflation erode all of their principal.
And so when you're talking about that, a product that comes to mind that many people are talking about are fixed indexed annuities, which are tied to a market index, which have an upside potential that's greater than what we're seeing with these interest rates, but there's no potential of losing principal. Is that a reason why you think some of these Wall Street firms have entered the index annuity market?
Absolutely, no doubt about it, Scott. For the last 6 or 7 years, we've been doing it for 13 years, what we call ourselves safe money managers. We're proud enough to say that in the last 13 years, out of my 30 years in business, when I was converted to a safe money manager, we haven't had one single client lose one penny in their accounts, whether it's accumulation accounts or retirement accounts or retirement income payout accounts. But Wall Street saw a substantial amount of money coming off the table back in the recession, and they realized that the technology and innovations that are out there now to provide people with guarantees and substantial growth potentials well above the average money market and CD rates, at the same time also tying their money to the stock market without risking any of their principal in it, is they basically conceded, hey, this is a great idea, and maybe we need to innovate some of these products and services with the technology out there to where people don't actually have to put their principal in the stock market but can still participate in it.
Mm-hmm. David, if someone watching this wanted to get in touch with you and ask some questions, how could they do that?
Several ways, Scott. First, they could call our toll-free 800 number, 1-800-790-0980, or visit our website, Adage Financial, ADAGE Financial.com, or they could also see us and follow us on Facebook,
David, thank you so much. My guest has been David Templeton. He is with Adage Financial Consultants in Little Rock, Arkansas. And you're watching Retirement News Today. You can find more at retirementnewstoday.com.